Imagine you have a business that's worth $1 million and you need another $1 million to make it worth $20 million. You know how to make it happen. And someday someone walks into your office and gives you the money, but there's a catch. They want 50% of your company. Obviously, you say no. Then another person, someone else walks in and offers you the same $1 million. They don't want half your company, they just want their money back, or with interest. I think that sounds like an easy decision until you realize that if your business fails, the second person can still come after you. So, and if it succeeds spectacularly, you've just made the second person rich without giving them a single share of your company. And now here's where it gets interesting. The world's biggest companies routinely borrow billions of dollars even when they already have billions sitting in the bank. Why? Because sophisticated capital allocators understand something most people never learn. Money isn't the asset. The structure around the money is the asset. And the structure determines who gets paid first, who takes the risk, who controls the company, and who gets most of the upside. So today we are going to break down the 3 fundamental ways a business can fund itself: debt, equity, or your own money. And by the end, you understand why the question isn't simply, where do I get the money? The real question is, whose money should I use? And what am I giving them in return? So, welcome to Black Finance. So let's make this ridiculously simple. There are 3 ways to build a business. First, you use your own money. You save $50,000. You start the company. You make $100,000. You reinvest it. Then $200,000. Then $500,000. You keep doing that until the business becomes something meaningful. That's bootstrapping. The second option is equity. You say, I don't have enough money to build this myself, so I'll sell part of the company to someone who does. They give you capital, you give them ownership. If the company becomes enormously valuable, they win and you win. But you're permanently giving away part of the economic upside and potentially part of the control. The third option is debt. You say, I don't want to sell part of my company. That's fine. I'll borrow the money instead. The lender doesn't usually care about your dreams. They care about repayment. You can get the capital. You get the capital. They get interest. And once you repay them, they're gone. That sounds simple. But underneath these 3 choices is a much bigger question. Who gets to participate in the future of the business? Because equity participates in the future, but debt usually doesn't. And that difference changes everything. Let's start with equity. Suppose you build a company from nothing. At the beginning, you own 100%. That sounds fantastic. But 100% of a company worth nothing is still worth nothing. Then someone offers you $1 million for 20% of the business. Now you own 80%. But if that $1 million turns the company into a $20 million business, your 80% is worth $16 million. You gave away 20%, but you potentially created something much larger. That's the fundamental argument for equity. You sacrifice ownership today for scale tomorrow. And this is why venture capital exists. A startup might have brilliant engineers, an enormous market opportunity, and absolutely no cash flow. A bank looks at it and says, come back when you have revenue. A venture capitalist looks at it and says, show me what this could become. I think that's a completely different type of capital. And equity investors don't just bring money. They can bring employees, connections, distribution, credibility, customers, future investors. Sometimes the money is actually the least interesting thing they bring. But here's the price. Every time you sell equity, you're not just raising money. You are changing the ownership structure of the company. And eventually, that can change who is actually in charge. One of the most famous examples is Steve Jobs. Steve Jobs co-founded Apple with Steve Wozniak. But in 1985, at just 30 years old, he was pushed out of the company after a power struggle with Apple's board and CEO John Sculley. The important lesson isn't simply that Steve Jobs got fired, it's why this was possible at all. A corporation is not the same thing as its founder. Once ownership becomes distributed, the company develops its own governance structure, boards, shareholders, executives, voting rights, legal obligations. And suddenly, the person who had the original idea isn't necessarily the person with the final say. Jobs later described being forced out of Apple as devastating, but he eventually returned and Apple itself became one of the most valuable companies in the world. So the lesson is, equity can give you capital without requiring repayment, but it can also give other people a claim on the future you are building. And that claim can eventually become a claim on control. But here's where people make a mistake. They hear equity means losing ownership and conclude debt is better. Not necessarily. Imagine you own 100% of a company worth $1 million. Someone offers you $10 million for 30% of the company. And you might immediately think, I'm not giving away 30% of my company. But let's run the numbers. If their capital and expertise helps turn that company into a $100 million business, your remaining 70% is worth $70 million. You didn't lose 30%. You created a much larger pie. This is the paradox of equity. Sometimes owning less creates more wealth. And this is why sophisticated founders don't obsess over percentages in isolation. They ask, what will this capital do? If giving away 20% allows you to build a company worth 10 times more, that dilution might be or may be incredibly cheap. But if you give away 20% just to pay salaries, rent, and keep an inefficient company alive, you may have sold part of the future to finance the present. And that's a terrible trade. And this is where the difference between good capital and bad capital becomes critical. So now let's flip the equation. You don't want to sell part of your company. Fine. So you borrow. Let's say you borrow $1 million at 8%. The lender doesn't receive 20% of your company. You only receive interest. You keep the equity. You keep the upside. You control the full company. And once the debt is repaid, the lender doesn't suddenly own half of your business. This is why debt can be incredibly powerful. But there is a fundamental difference. Equity shares your upside. Debt shares your downside differently. If your company becomes worth 100 billion, your lender doesn't suddenly say, congratulations, I now own 20%. They still receive what the contract says they owed. That's fantastic for the owner, but dangerous when things go wrong. Because the lender doesn't necessarily care that you are having a bad quarter. Your payment is due. Monday, Tuesday, Wednesday, every month. Whether the business is thriving or bleeding, that's the trade. Equity gives you flexibility but sacrifices ownership. Debt preserves ownership but creates obligation. And obligation is where leverage becomes both a weapon and a trap. So, let's say you have $1 million. You could buy $1 million asset, or you could potentially use that $1 million as equity and borrow another $4 million. Now you control a $5 million asset. If that asset rises 20%, you have created a $1 million gain on a $5 million asset. That's 100% gain relative to your original $1 million equity. That's leverage. And this is one of the most important concepts in finance. You don't necessarily become wealthy by owning more assets. You can become wealthy by controlling large productive assets with relatively little of your own capital. This is everywhere. Real estate, in private equity, infrastructure, corporate finance, shipping, energy, telecommunications, and of course, banking. But there's a dark side to all this. If that $5 million asset falls 20%, you have just lost your entire $1 million equity. And if it falls further, now you're underwater. So leverage doesn't change the economics of an asset. It changes who experiences the consequences first. That's why professional investors obsess over something ordinary people often ignore, which is the capital stack. So imagine a company or a building, is worth $100 million, but it has $60 million of debt and $40 million of equity. Who gets paid first if the asset is sold? Obviously, the debt holders. They are higher in the capital structure. Then comes other layers of financing. And finally, the common shareholders. This is why two people can invest in exactly the same company and have completely different economic experiences. The lender might earn 8%. The preferred investor might earn 12%. The common shareholder might make 40% or lose 100%. The higher your potential return, the more uncertainty you are usually accepting. And this is the part of finance that gets missed when people say, I want higher returns. Higher returns don't appear from nowhere. Someone is paying you to absorb something. Whether it's risk, illiquidity, volatility, subordination, duration, complexity, or the possibility that you lose everything. Return is the price of taking risks nobody else wants to take. And the capital stack is simply the architecture that decides who takes that risk. Now, we get to the part that seems completely irrational. Why would a company with billions of dollars in cash borrow money? I think someone like Apple. Because corporate finance isn't about asking, do we have cash? It's about asking, what is the cheapest and most efficient source of capital? A company can have cash and still choose debt if borrowing is attractive relative to other uses of its capital. Apple's financial statements, for example, shows enormous cash and marketable securities alongside significant debt obligations. Why? Because cash has an opportunity cost. If Apple can borrow at an attractive rate while using its own cash for other purposes, the decision isn't simply debt bad, cash good. It's what generates the highest risk-adjusted return on each dollar of capital. This is how sophisticated allocators think. They don't worship cash. They don't worship debt. They don't worship equity. They optimize the structure. And sometimes debt can even be used to return capital to shareholders through dividends or share repurchases. The company isn't necessarily saying we need money to survive. It can be saying we know how to deploy capital and this is the cheapest way to finance the structure we want. But there's a catch. That logic works beautifully until the environment changes. Imagine you borrowed $100 million from when the interest rates were cheap. Your business is profitable. Everything looks fine. Then your debt matures. You don't necessarily have $100 million sitting in the bank. So you need to refinance. You go back to the market, but now interest rates are higher. Banks are more cautious. Investors want better returns. Your asset has fallen in value. Suddenly, the same $100 million of debt that looked harmless 3 years ago becomes a problem. This is one of the hidden dangers of modern finance. You can be right about the assets and still lose because you were wrong about the financing. The building can be excellent, the company can be profitable, the business can have great long-term economics, but if your liabilities come due before your assets generate enough cash, you have a liquidity problem. And liquidity problems can kill otherwise viable businesses. This is why professional capital allocators don't only ask, what will this business be worth? They ask, when does the business come due? Who will refinance me? At what interest rate? What happens if the market disappears? That's the difference between owning an asset and understanding its financing. And then there's the third part, bootstrapping. No VC, no bank, no outside investor, just you. Your company, your customers fund the company. Your profits fund the next stage. You grow at the speed your economics allow. And there is something incredibly powerful about this. You maintain control. You aren't answering to shareholders. You aren't negotiating board seats. You aren't worrying about your next funding round. You don't have to grow because an investor needs an exit. You grow because the economics make sense. But bootstrapping has its own hidden cost. Time. If your competitor raises $50 million while you have $500,000, they can hire faster, they can buy competitors, they can enter markets, build infrastructure, spend on distribution, and potentially destroy your advantage before your business has time to mature. So bootstrapping isn't automatically smarter. It's a different trade. You are exchanging speed for control, and sometimes that's exactly what you want. Now zoom out. Let's zoom out now, because this isn't really a game about debt versus equity. It's a video about capital allocation. The average person asks, how much can I make? An entrepreneur asks, how much capital do I need? An investor asks, what return can I earn? But a sophisticated capital allocator asks a different question. Where should every dollar sit in the capital structure? Should I own it? Should I lend against it? Should I partner with someone who owns it? Should I use leverage? Should I sell equity? Should I retain earnings? Should I refinance? Should I acquire? Should I wait? These decisions compound. And this is why two people with the exact same amount of money can end up in completely different places 20 years later. One spends, one saves, one buys assets, one buys businesses, one lends, one uses leverage, one sells equity, and one keeps control. They are all interacting with the same financial system, but they are playing completely different games. So let's return to the question we started with. Would you rather own 100% of a small cake or 10% of the bakery that produces thousands of them every day? The beginner thinks the answer is obvious. I want 100%. The sophisticated answer is it depends. How much is the bakery worth? How fast is it growing? How much debt does it have? Who controls it? What rights come with my 10%? What happens if the business fails? Who gets paid first? What is the cost of capital? And most importantly, what can my capital become if I put it somewhere else? Because wealth isn't simply about having money. It's about deciding what your money gets to control. Debt gives you leverage. Equity gives you participation. Bootstrapping gives you control. And every great fortune is built through some combination of those three. The people who understand this don't look at money as something to simply accumulate. They look at it as a tool, a claim on future cash flows, a vote, a liability, a lever, a partnership, a weapon, a constraint, or an option. And once you start seeing money that way, you stop asking, how much money do I have? And you start asking the much more important questions. What can I control with the money I have? Because in the end, money is only the ammunition. Capital allocation is the strategy. And the people who understand the strategy are the ones who decide where the money moves next. This is Black Finance. And if you want to understand the systems behind wealth, markets, businesses, and capital, not just what happened, but why it happened, subscribe. Because the visible economy is only the surface. The real game is underneath. Understand where the money behind the word. Black Finance.